Good afternoon, everyone. My name is Carlo Martuscelli, and I'm European economy reporter for Politico. You're watching Politico Live, the live extension of our nonpartisan journalism. Europe has a money problem, or rather, it has a problem getting its money into the right places. For a long time, the issue was on the back burner. Yes, there was the Capital Markets Union project for over a decade, but national interests trumped EU-wide priorities, and progress was glacial. But the war in Ukraine, the necessity of decarbonization, and the sinking feeling that the continent is falling further and further behind what has become a two-way technological race between the US and China has meant that fixing the EU's fragmented financial system is simply a problem that's too big to ignore. The first sign that something was changing was the high-level recommendations contained in the Letta and Draghi reports. This was followed by the Commission's rebranding and relaunch of the project under the name of the Savings and Investment Union. National capitals, including Paris and Berlin, have, in words at least, given their backing to further financial integration. Still, obstacles remain. When it comes to the Capital Markets Union, everyone is a backer until it comes to agreeing on the fine print. One is reminded of St. Augustine's famous line, "Lord, make me stop sinning, but not yet." Today, we'll kick off with an interview between Joanna Roberts, Politico's policy editor, and Gillian Flores, Chief Advocacy Officer at the Managed Funds Association. Then we'll continue with a high-level panel diving into the Savings Investment Unions, moderated by me. Before we begin, I'd like to thank the Managed Funds Association for making this event possible, and a big thanks to all of you, our audience, whether in Brussels or online. At Politico, we like to keep these conversations lively, so you can send your questions via Slido using the hashtag #InvestSingleMarket. Questions with a name and organization get priority. We want to hear from you right away, so please take a moment and answer our poll presented by MFA. What is the biggest obstacle to turning the EU's Savings and Investment Union into a true engine for competitiveness? We'll look at the results at the end of the discussion. So to kick things off, please welcome Joanna Roberts and Gillian Flores on stage.
Thank you very much, Carlo. Good afternoon, everybody. Thank you for being here. My name is Joanna Roberts. I'm policy editor for Politico, and I'm sitting down with Gillian Flores, the Chief Advocacy Officer at MFA. So thank you very much for being here, Gillian. Let's dive straight in. Carlo was talking about the timing, and it was the first thing I really wanted to ask you about as well. I mean, a capital markets union in Europe has been on the cards for a while, to say it mildly, but with very little progress. So there is a lot of sort of skepticism surrounding the project. But also there's a sense that the stars are maybe now beginning to align a little bit in terms of the momentum. What's your take on that? What are you seeing?
Thank you. And first, Joanna, Politico, thank you for having us. It's really a pleasure to be in Brussels with you here today. We're thrilled to talk about all these really important topics. Let's start with SIU, because what could be a more important framing for the conversation today? Yes, we are very much of the belief that there is a renewed energy and momentum around the initiative to really expand and grow capital markets activity across the EU. We commend some of the early signs of that, securitization in particular. I think it's something that clearly is moving. It's underway. We'll see where it lands, but it's really important that it's already mid-year and we're going to start to see some signs of progress there. But we also think that there are areas where we could go even bolder. So we're hopeful that this really is the time where, as you said, the stars have aligned, where there's momentum to get some stuff done and really drive forward the growth and competitiveness of the EU.
And in terms of your particular organisation, what is your interest in the Savings and Investments Union, and what do you kind of want to see from it?
So to start, our organization is a trade association across the globe representing large, globally active alternative asset managers. So hedge funds, private credit funds that are interested in investing in businesses across the EU. They are interested in serving investors in the EU and really being a part of the capital markets activity that they already are very much a part of and want to see that expand and grow because that's helpful to them. It gives them opportunity as well. So we really come in at it with that investor lens to expand opportunities and really kind of push forward the benefits of a more harmonized EU across the 27 member states, as well as just really energizing capital markets investments.
And what are some of the key frustrations that you hear your members expressing?
You know, I wouldn't put in the context of frustrations, but maybe I'll start by digging into securitization a little bit more, because again, I think that's a real bright spot and an early sign. We think that it can enable just the expansion of capital into the hands of more of the real economy in the EU. And that benefits, obviously, very directly the real economy. It also benefits financial stability. It's diversifying risk outside of the handful of banks that would otherwise be in the activity itself. And it helps investors. Investors are able to better diversify their own investment portfolios away from a very blunt 60-40 index fund, for example, by really kind of touching more of the underlying activity in the economy. So on that front, we want a few things. And I know here in a few weeks, we'll have a better sense of the direction of travel. Importantly, we have to narrow the definitions around securitization so that investors or potential investors know what is and isn't deemed in that model. Right now, it's quite complex. Critically important that we remove the onerous duplicative due diligence requirements on investors. And that's not only important for investors investing in an EU-issued securitization, but also it is a global market. So looking beyond only EU-issued securitizations is an important component. And thinking about who is sponsoring or could sponsor securitization activities, making it easier for an EU AFUM, for example, to be a part of that process directly.
Yeah, and I know the securitization part is due on June the 17th. I know Politico, we did get our hands on a draft, so we have some sense of what certainly was in the proposal. And there is this, loosening of, or sort of loosening direction towards due diligence. Some of the more spicy political issues seem to not have been covered so far, like creation of a EU-wide platform for securitizations and so on. So I don't know if you saw the draft. Do we have any comments or?
We've seen materials that we hope continue to improve here in the weeks ahead, but certainly are headed in a really positive direction. And whether the transparency components or, as you say, the due diligence components, which might only be intended for EU-issued securitizations at this point, we hope that there will be an effort and an interest in expanding that because, again, this is a global marketplace and really kind of putting up borders that stymie the ability for investors here to have all of the opportunities doesn't serve the investors here as well.
Okay. And maybe moving on to another of the, beyond securitization, another of the issues that's going to be tackled, I guess, a bit further down the line, which also proves to be probably generating some fireworks, is the central supervision issue. Banks have central supervision under the ECB, so what about the non-bank sector?
I can't wait to hear our next panel, as I suspect it might come up, and we'll have some interesting views from important stakeholders. We look at it, I guess, from a few different perspectives. One, of course, there are benefits to our members and to markets and investors, and the greatest consistency and harmonization as possible. I think one of the questions is a matter of, is it central supervision? Is it a central supervisor? What are the differences? Is that important? How does that look? But I think there are ways of kind of pushing forward with a broader narrative of that harmonization and consistency that I think it would be hard to object to. And it's a matter of getting it right and deciding, whether many different entities should be doing something in much the same way or it truly needs to be consolidated in one geographic location, for example.
And yes, so Carlo, there's maybe a question for the panel. What else would you'd like to see? Some things that aren't covered to give your members the appetite to invest more in Europe.
So I mentioned that we are thrilled at the work underway, but really feel like there is a lot of room to continue to kind of grow that in a more robust way. One area that MFA spends a lot of time, and it's critically important to our members, but importantly, we believe critically important to accomplishing the objectives of ensuring that the EU is as competitive as possible with deep and liquid markets and investors who are getting a fair shake at their investment experience. And that's around short sale regulation. It's an oft misunderstood part of capital markets, but again, a critically important one that allows investors to be in a market and hedge their investments. It also is a tool for investors to express a view that a company is overvalued, and whether that's because it's overvalued relative to another similar company, or because perhaps they are investigating that company and have determined that it has terrible governance processes or bad accounting, or in some cases, of course, we've seen this with Wirecard, outright corporate fraud. And when that's happening, investors are being harmed by investing in those companies. So we think that there is an opportunity within the SIU context to recalibrate the short sale regulation. It's a really important regulation, but to modify it in a way that removes the individual position disclosure of a manager's positions from public consumption. That would still be, of course, provided to regulators. But for the public, if you are an investor or a potential investor, what's most decision useful to you is knowing on an issuer basis in aggregate how much is that company being shorted. So we think that that's actually better for the investor and will encourage more overall investment activity in the EU, because managers who can't short or are not comfortable shorting because they're very reluctant to hit a public disclosure threshold, which basically discloses their IP, are also not on the long side, because many of them, of course, are running strategies where they're hedged out. So we think it's a very easy and sensible part of a potential SIU kind of next iteration of progress that could be made.
I do actually have a comment from the Commission on short selling, because we did ask them why it wasn't, being considered under the SIU. They said the current framework effectively delivers on its core objectives, being enhancement of market transparency, prevention of manipulation, ensuring a level playing field for investors, and promotion of market integrity. They did say one area where there is room for fine-tuning is the information on short sales is being disclosed, but it requires further assessment as well as reopening primary legislation. And for the moment, the focus is to deliver on the Savings and Investments Union, so they don't want to reopen too many legislations at the same time, so it's not a priority. What would you say to that?
I would respectfully agree with so much of what they've said, but disagree that this is in addition to the SIU. We believe this is very much a part of the objectives of the SIU. And considering, even though it's, of course, an endeavor to reopen a file, it's well worth the effort when thinking of how it could just really be tweaked and send a strong message around the world that the EU is promoting capital markets in a way consistent with the US and the UK in this case, but also other regions around the world, and really promoting more investment to be happening here in capital markets.
Okay. Moving away maybe from some of the specifics to, bouncing off that question about not reopening primary legislation, there is a lot of legislation that's being re-looked at the moment under the simplification agenda of the EU. I know this is a sort of trend that echoes in other parts of the world. What's your sort of take on simplification of financial rules?
You're absolutely right. And as you all can probably tell, I have a US accent and spend a lot of my time in Washington, D.C., where it's a live conversation right now in terms of how to right-size a lot of different regulations, not across the board, but certainly more so than we've seen in recent years. And in most core jurisdictions where capital markets activity is thriving, I think it's an important discourse right now to assess rules and regulations and to get them right, not to remove them. It's very important that we have clear and strong rules of the road that give credibility to the region in which we're operating. But certainly in any jurisdiction, there are things that are not fit for purpose or no longer serve a purpose and are discouraging investment activity. So we are really excited to be a part of the conversation about what those areas are and how to do it in a way that's thoughtful and ultimately protects the investors and provides what businesses on the ground need as well.
Because I guess there is, as well as legitimate arguments towards simplification, there's a lot of nervousness around the potential to deregulate. And as I was preparing for this interview, one of the things I kept hearing was the non-bank financial instruments are viewed as like quite a risk factor for the next financial crisis. So is this something we should be worried about?
It's something we should be talking about. It is no question, with the growth of the role that alternative asset managers in particular, but beyond that, a lot of different things that fall in the so-called non-bank category are serving in markets. Of course, policymakers need to be watching that activity closely and making sure it's well understood. I would say in the context of the SIU, for example, while on the one hand, the conversation is really about growing capital markets, having sensible regulation, encouraging, that activity is largely provided by or could be provided by non-banks. And there is a friction and a tension in, at the same time, this conversation that might sometimes, not always, make a knee-jerk reaction or assumption that non-bank activity, because it's not regulated like a bank, is somehow inherently risky. And we think actually quite the contrary, that it is net stabilizing to the system to have this diversity of activity. And market participants such as hedge funds and private credit funds are not subject to a taxpayer bailout. They are not subject to run risk and redemption risk in the same way that banks are, which again, banks serve a very important part in the ecosystem. But we think that getting really good information around the non-bank activity is critically important. And we think that multilateral global standards setting bodies are going to spend a lot of time in the coming months and years thinking about data of the industry. But we discourage kind of an overreaction or a jump to overregulate that activity because it fundamentally would undermine the SIU objectives, for one thing.
Okay, I see we're running out of time, so I'll make this question quite short. And the Commission, or Ursula von der Leyen, said it wants to prioritize the creation of a US-style investment culture here, given that you're from the US. What are some of the lessons that we could take? Or what's your sort of one big takeaway that you think we could transfer from the US to here, or not transfer?
It's a great question, and it also brings to mind a theme that we're spending a lot of time on in the US, and I think is very relevant to this in the EU as well, and that's the so-called retailization trends. And that's specific in many cases to private markets activity or alternative asset management. But really thinking about a saver, ultimately saving in cash is, I think we all recognize, not going to be able to well meet her or his needs longer term. So where else should savers be putting their money to work? Simplified access to equity markets and bond markets is a start. But really, I think that has shown over time that it's not always the full picture and right for every investor. But having other diversifiers that really pick up important market activity in private markets, for example, is something that we welcome, I think, a growing conversation across the EU about exactly what that looks like. So I would say just having a lot of optionality, but also importantly, a lot of education to ensure that when more investors or more savers start to get interested in different parts of the markets, there is some level of a guardrail there so that they have a reasonable expectation of knowing what they're investing in.
Okay, brilliant. Thank you. And that's right on time. I have so many more questions, but we have to leave it there.
Well,
thank you so much for your insights, Gillian. I think it sets the stage nicely for the upcoming panel on the Savings and Investments Union with our guests, and moderated by our economy reporter, Carlo Martuscelli. Thank you very much.
Thank you.
Great. Well, first, I just want to thank Joanna for that really interesting interview. I think we hit on a lot of the topics we're going to discuss now. For example, the single market supervision, the growth of non-bank financial institutions, simplification. So that's a very rich vein to draw on. Let's just jump into it right away. I always like to start things out with a little quick round. So I'm going to ask a question, and I'm going to ask that you keep your answer to a minute, and we'll just go around. My first question is, the idea of the capital markets union has been around for 10 years. Why is it different this time, if it is? If you disagree, please feel free. And this is kind of the question Joanna asked as well. So, Bertrand, maybe because you're joining online, let's start with you, and then we can go around the room. And we can't hear you. Okay.
Yes. Do you hear me?
Yes,
it's working properly?
Yeah.
Thank you. So thank you for having me, and sorry not to be with you in Brussels. I am actually stuck in Paris because we hosted today in Bercy, and we might discuss this a bit later, an event that was precisely on the CMU, or one of the most, I think, interesting initiative on CMU, which is the launching of a label on a saving product that has been promoted and supported by a couple of member states today. And I hope this will pave the way for other initiative, other breakthrough in this CMU work stream. So to your question, why is it different? And basically, why are there reasons of hope? I would submit two arguments. The first one is that on substance, things are not that different from what they were 10, 15 years ago when the CMU initiative was launched. It's still about financing European economy, making sure that European savings are more tilted toward financing of our economy, more financing of innovation, more mobilization of EU financial actors. So the situation is not that different. But I think we have managed to do two things in the last months. First is streamline or reorganize the agenda with 3 or 4, let's say, core initiatives that have to do with saving. I was just referring to it, with supervision, with securitization, and obviously post-market will be also one of the main chapter. And the second element is that I think there is now a political momentum that has been built, of course, together with the new commission, and we have an agenda, we have clear targets, and hopefully we'll be able to deliver based on this new approach, as opposed to a method that was very comprehensive, very detailed, but I think lost a bit of the political energy that is needed to make progress in such an area.
Okay, great. Verena, maybe we can start with you and then go around the room.
Sure. First of all, thank you very much. Very good to be here. So it's easy to follow on from Bertrand because for me, what is different this time is that it's really the environment in which we are as Europe. I think we've always been in a place where our capital markets have not really thrived as we had hoped, and the CMU was trying to do that, but clearly, while we have made some important steps, we are not there, and we need to be. And I think the external environment and the pressures that we are now facing are giving a different political dimension to this, to the Savings and Investment Union. So from that perspective, I think both for the competitiveness of the European Union, for our ability to, on the one hand, finance the huge needs that we have, and for making sure that actually our citizens and investors have the opportunities to engage productively in capital markets. For all those reasons, there's now a completely different political momentum, and that's both at the European level, but also importantly, and I think a change at the national level. And a lot of what we need to do needs to really come from both sides.
Great.
Yeah, also from my side, many thanks. I'm really looking forward to this very nice and important conference. Well, I think if we really want to have a big project, and Saving and Investment Union is a big project, of course, it's always said you need a crisis, but maybe I'm not going so far. But you need a very strong momentum, and I think this is indeed now what we have. And why do we have it? Because compared to the time 2015, when we started with CMU, okay, we had also challenges, but now we have a really economic challenge, where we have also to take our destiny as Europeans in the hand. Our economy is not looking that good, and to bring this forward, we simply need the sufficient financial push to get it done. And that is, I think, quite an acute situation. And then there's, of course, also the new geopolitical situation. I would have wished we would not have it, but perhaps if it helps us with SIU, and you know all this very well, we need to put a huge amount of money into our defense and to make Europe also internationally a credible player. And for that, I would say, and this is, I'm echoing what my commissioner already said, it's not anymore nice to have, but a must-have.
Great. Fernando.
Okay, first of all, thank you for the invitation. So why this time might be different? I think maybe...
If you think it is different, you can disagree.
I think in
mean,
substance, I fully agree with Bertrand. In
Okay.
substance, there is nothing new under the sun in particular. But I think politically it is. But maybe, well, I think it's been positively portrayed as, okay, now there is momentum, but there is also the flip side of the coin, that after what will be effectively the third attempt, there might not be a fourth attempt. So maybe this is the last chance to get it right. Okay, no, just political capital erodes, I mean, and credibility vanishes, and I think we take that there is the need, and maybe after two partial successes, not put it as failures, but partial successes, very partial ones, now is the time to get something more substantial. So I think it's it's always as in life, it's both push and pull factors that lead to success. So let's use both in the same objective.
So, Fernando, as a journalist, I always love a skeptical voice on the panel, so that's very much appreciated. Bertrand, I thought we could begin with you, just because you have your labeling announcement, your labeling of financial products. So my question is this, and maybe this is also an opportunity to briefly explain what the proposal is, but if you're trying to encourage Europeans to put more money into equities, which just means into the stock market, into companies, is there the risk that you're pulling money away from government debt, from the bond market? And I ask you, of course, because France has had, I think we can say, maybe a slightly rough year when it comes to the bond markets. We've seen, yields go up and down, and there have been some worries. So isn't there the risk that you're shooting yourself in the foot a bit if suddenly everyone starts, throwing all their money into, LVMH or, whatever, the stock market in general?
Well, it's a fair question, but I think the reality is pretty different, at least for 2 or 3 reasons. The first one is that obviously we don't expect all the saving from European households to go directly in capital market in the next day, and that there would be no demand for sovereign debt all of a sudden. So I think that it's more about incremental evolution vis-à-vis a capital market. That's point one. Point two, which is evident, is that one of the true assets that Europe has is the current level of saving. It might triggers other kind of questions from a macroeconomic point of view, but clearly from a financial point of view, we have a very robust base. I think the numbers are well known. You have 30 trillion of financial assets within that are within the end of European households, and it increases every year around 1,000 billion. So basically, there is a lot of room for maneuver, a large room for maneuver, and we also know that a significant part of these saving are directed to investment in third countries, in particular in the US, but also in Asia. So it's more about reallocating, reorienting, and being sure that we have more investment in Europe, more investment in the most innovative part of our economies. And this will be, I think, one of the key driver of Europe future competitiveness. I think this was also one of the key messages from both the Draghi and from the Letta report. So I'm not worried by this. I think pretty much the opposite. We have a robust base to build something. Second, what we have tried to do here is a bit different in terms of method. So under the aegis of the Spanish Lab initiative, we have tried to create a coalition of the willing of member states. Instead of creating a saving product at EU level based on the regulation, we have decided to agree on a set of principles that would be sufficiently consistent to ensure that the saving that would be collected can be managed as a pool of liquidity, as a pool of investment by financial actors. The idea is to overcome the current fragmentation of the saving market in Europe and give scale to our actors when they want to invest in Europe. So this is the idea. And what we have managed to do today in Paris is to agree on a couple of principles that will frame this saving product, i.e. a time horizon, which is minimum 5 years for investment. It's clearly a product that is not going to be guaranteed by governments. It's a product that has a clear allocation to Europe with a 70% minimum allocation to investment in European economy, and that will benefit in each of our jurisdictions of a favorable tax treatment. 7 countries have joined today, and of course more are expected, more are welcome, and we have built this together under the umbrella of the Spanish initiative and in close cooperation with the European Commission.
Great. Maybe I can ask some of the panelists to respond to this coalition of the willing approach, because you know, on the one hand, you can say it's a way that member states can start taking action and moving towards a savings and investment union, bypassing some of the sclerosis we might see through the typical European process. But on the other hand, you could argue maybe it actually fragments things even more. So maybe, Verena, we can start with you. I mean, if you have any thoughts about the coalition of the willing approach that was pioneered by Spain, actually, and then, yeah.
No, I think, first of all, I think the idea of trying to find ways to get European citizens to shift their savings, or at least think about, let's be careful here. We don't want to, you know, government-wise direct, you know, what people are supposed to do with their money. It's their choice, let's be clear. But I think to create something that actually offers an attractive proposition to maybe use some of the savings that are currently sitting in a bank account and not earning anything on a current account to actually invest in something that ultimately provides productive funding for real companies and economic growth, and on the other hand, provides some returns of possibilities of returns that are clearly superior, I think is a win-win situation. Some of what has been put forward, and I think is very beneficial, is the fact that, you know, some of the measures that are being talked about are things that can only be done at national level. Things like thinking about potential tax treatments and so on is something that you couldn't do easily at a European level. So from that perspective, I think it's really beneficial to have that kind of support of doing something in this space. I think in the end, it will be important to make sure that we, however, also create something that doesn't create further barriers of fragmentation in the European market. So investors should still be able to invest wherever they want in the EU. They should face pretty similar kind of outcomes and requirements, and also get the right information to make the right choices. And I think that we owe to a European investor in the single market.
Alexander, do you have any thoughts about that in terms of the fragmentation, or or maybe it's a good idea, whatever you think?
Yeah, maybe I would take it, if I may, from two sides. I mean, I'm a lawyer. And of course, I think sometimes if you do things in Europe, we have what we call the community method. And this has proved quite successfully, because the Commission makes a proposal, Council and Parliament negotiate. But that does not mean that there may be reasons where we have, so to say, and Bertrand explained it very well, lab situation where maybe some member states go forward with an idea, especially I would say in those areas where it is very difficult to find an agreement at EU level. I mean, it's not so much on what is now the label about, but more on things that more in a competence where member states think very strongly, taxation, insolvency, you know it well. But if this is done indeed somehow to test an idea, I think this is very interesting. We have also followed this project very closely from the Commission side. So I think that is a bit of an experiment, but certainly good. And if I still may, my second point, why I think it is really an interesting project is because it touches on the retail investor issue, very much in line what Verena just said. It's also for us, as you know, one major element we would like to work on. We are actually also doing this with the idea of having a sort of blueprint for a saving and investment account. In the end, I think what we now have with the initiative that was born today in Paris and what we are planning, we may have quite a good complementarity. So I'm not that much afraid of fragmentation. But of course, it's a bit of an experiment, and we will see how it goes and what works, and you have to start somewhere.
Okay, so seems like agreement. Fernando, do you have any thoughts on it, or?
Okay, I have many thoughts.
Oh, yeah, please.
Different levels. Okay, so first of all, I think it's good in terms of final objective that a lot of political capital is put into this idea that what we are lacking mostly in terms of investment is in the equity space. Okay, so we have money. This is for the good of. We're fortunate that this is not a problem of lacking money. Quite the contrary. We have a lot of money. It's simply not in what we consider to be allocated in the most productive way. But what Verena mentioned is absolutely crucial. Allocation of investments at an individual level has to be mostly an individual decisions. And now I have the fear that some of the narrative that is going in, some of the initiatives are trying to, instead of pulling a string, we're pushing it. So we are basically putting taxpayers' money, and that obviously derives that has to be mostly a national initiative, so the traditional European method. I mean, it's insufficient in this regard because you have to have a commitment of national tax authorities. But I fail to see, for example, this idea. But I mean, politically, it seems obvious. Okay, as long as you're incentivizing with taxpayers' money, then imposing these restrictions on asset allocation, 70%. But that's suboptimal. This should be much more organic, and in particular in the countries that this work more organically, even when they have a subsidy, you tend to be you don't have these restrictions embedded in the label or in the product or whatever or the account or whatever you want to call it. I think we should try it. Maybe it may take longer, and harder, but I think it would be more resilient if you do it the hard way. You improve the macro, you get more projects providing more attractive risk-return propositions in Europe, and then you'll have organically the people voluntarily deciding to invest more in equities. You may say, okay, that may take decades. Okay, fine, fair point. But I think it will be much more sustainable. Maybe this is just as a kickstart, might make sense. But if you believe the market is going to be driven by tax reliefs, with this restriction in asset allocation, if you believe that the traditional home bias is not enough and you want to impose even more on that, this is not going to be a vibrant and internationally competitive capital markets. But I fully share that if it's this to kickstart the market as a kickstart engine, okay, might do some part of the trick, But you have to think long term, and we need more equity in our companies because that is what allows them to be more innovative. Innovation is funded mostly by the equity, not by debt. And for that, you have to do things also in the taxation space, but not on the demand side. It's also on the company side. We have debt equity bias, or our tax systems are biased in favor of debt. Why don't we focus on that? And that's, I think, it's more across the board. It's much more powerful, more long-term. I think, okay, maybe these short-term solutions can be a starting point, but we really have to think deeper on what is underlying.
Well, okay. Go ahead, because clearly this has impassioned people. We even got applause, but yeah. The last response, and then we'll move on from labeling.
No, I just wanted to very briefly come in to say that I think it's also important that we look, and that's why it's such a complex issue. You can't just look at one measure and assume that will solve your issue. You need something that is actually much broader. So we need to attract equally more institutional investors. We need to make sure that actually we have institutional money joining to actually invest in the European economy. So it has to be a measure of different points.
Okay. Okay. Yeah, I mean,
one sentence now. I think what is in the end important is that we sometimes I think we should again let people make the decisions. I would agree with that, but I think people also have to understand opportunities, and I think that is something that is lacking. So if we can start with something that is easy, attractive. You don't have to read 50 pages to understand what it is, but somehow to enable people to get more in the markets. Then I think we have already done a very important step forward.
Marketing for the markets.
Exactly.
Bertrand, since it is your project, I did want to give you a chance to respond, and then we'll move on from labeling.
I would not present it's my project. It's a project of a number of ministers that have subscribed to it today. We have worked together with a couple of colleagues on it throughout the past months. But so I just wanted to make two points somehow to respond to Fernando's point. The first is, of course, it's not about pushing households or investors in this product. I mean, it will be their decision. And if you read correctly and precisely what the term sheet that was agreed by minister, it's not about giving this product an extraordinary tax status. It's about giving this product one of the most favorable tax incentive compared to other saving products. So we are somehow increasing the offer for household, and clearly with a clear thesis that it's about investing in the European economy. And where I agree with you is that we have a bit of chicken and egg issue. What we are currently seeing is that funding in innovation in Europe is too limited. I think here again, it was one of the clear conclusions of the Draghi report, not enough investment and not enough investment in innovation. And what we are seeing is that currently innovation scale up, to take an example, are not funded by European fund, but by third countries, whereas we have this very robust saving base. And if you want to modify this, which means at the end of the day, this will offer better return for our saver, you need to change the logic. So at some point, you need to kickstart things, and I think this saving product will certainly help, and it's meant to do this, to initiate this change. And I'm pretty sure that some European household can be attracted by such an idea and by such a project. And the third thing I want to say is to fully agree with what Verena just said. We are, of course, not pretending with one project to change the overall financing of the Europe logic. We will need a couple of initiatives, but I think that one of the limits of the CMU as it was handled so far was this, numbers of initiatives that were difficult to monitor and to agree upon by ministers. So we have decided streamlined, focus on a couple of initiatives. It's of course not to say that as such each of them is sufficient to create a CMU. We are fully aware of this. You need to have a comprehensive approach, but I mean, you also need to take the building blocks one by one.
Okay, great. So I think we have covered labeling at the panel, so I'll move on and I'll move over to you, Alexandra. The European Commission is planning on delaying 122 technical standards for finance under its simplification drive, including rules for banks, insurers, and sustainability reporting. These are referred to as the so-called level 2 rules. Correct me if I'm wrong here, because this is a little technical, but are these rules really being delayed, or are you considering getting rid of them altogether?
Okay, I mean, first of all, to be very clear, this is not only for the European Commission to decide, because we have empowerments in EU legal acts that have been agreed by Council and Parliament. So if in the end this would have to be somehow a common decision. But I think it's a bit of misunderstandings here, what is happening. I mean, what we did after the first mandate of President von der Leyen, 2014-2019, that we made a sort of inventory of the legal acts we have adopted, the co-legislator has adopted in our field, including empowerments and level 2 acts. And we came to a number of more than 400. And we thought this needs a bit of a checking system. How can we manage this large amount of empowerments under the methodology? Do we really need them to make the level 1 legislation work? Are they essential? And we have, because it is a huge work, it's a huge work for Verena and her team, the other ESAs, but also for us bringing it into a legal form for the Council and Parliament in the end to do the scrutiny. So we thought it is better to somehow make a bit of a ranking in terms of priority. So it's not about not doing things, but I think it's more to see what do we need now, what has to come to make the legal text work, but what are maybe things where we have already guidelines and it's nice to have them in the legal text, but people can also do the guidelines. Is it something where things will anyway start later? To give you a concrete example, the European single, the ESAP, when this first has to be set up and then it has to be filled with life. So if things come maybe a few months later, it would not harm the project. So this is the idea behind. I acknowledge that this is a bit of an innovative approach, but on the other hand, we speak a lot about simplification, and rightly so. But we then should also have a bit of the courage and start to see where we can simplify without deregulating. And this is, again, this is not the Commission's answer to simplification. It's just an idea. And we are now in, I would say, very good talks with Council and Parliament, how we will go forward with that. This list is not cut in stone. It was a first idea from the Commission, and then we will see what comes out of it.
Wait, but sorry, are you getting rid of rules or not?
No, I mean, anyway, we cannot get rid of rules. If in the end, one empowerment is seen as not necessary, I think that would need a legal decision. We cannot simply, Commission decide, okay, thank you, co-legislator, but we are not doing it. Then Council and Parliament would have to make a proposal saying we will delete the empowerment X in Article Y, and then there is a decision to be made by the co-legislator.
Okay. So maybe, or
maybe the Commission may do a proposal, and then maybe Council and Parliament may decide that it is obsolete.
So it's okay. It's a maybe. Okay. Verena, what do you think both of the specific list of the secondary legislation, but also this idea of like simplification in general, you know, from where you're sitting?
So first of all, I think the idea that you actually look critically again at what should be your first priorities and where maybe does it make sense to slow down a bit or reprioritize your resources and your efforts, I think is always a good thing. We do that on an annual basis, actually, because we have so many resources and we get more and more demands, so we have to do that. I think that's good housekeeping and a good process. But I think more generally, and I believe the whole issue of simplification and burden reduction is something that, you know, is important to look at seriously, because Europe has the issue that at least it's perceived to. I would want to be careful about, you know, what here reality and perception might not always be alike, but it's clear that we have a framework which is quite complex, because we have to always try to bring 27 different views together. And that means that we often try to also go into a lot of detail to specify what this particular thing means and so on. And very often things that are decided at level 1 end up, you know, not kind of finding a compromise and then saying, but at level 2 you can specify that further. So, and then we are landed with an issue which is not always easy to resolve. In other cases, we believe that actually maybe sometimes not being so specific at level 1 can also be an advantage, because it could actually be higher level. You could have more agile regulation underneath that actually allows you to be more responsive to market developments than having to reopen level 1 acts. So there's a lot that we should think about when we look at our overall regulatory system, to my mind. The balance between level 1, level 2, and level 3, I think each have their role to play, but I think it's worthwhile having another look whether we can somehow make it work better overall for the system and for the market. And as part of that, certainly we at ESMA, we're very proactively trying to think, are there things that we can ourselves simplify or reduce a reporting burden? We are looking at that on data reporting. We are looking at that. We just published a call for evidence on the investor journey. So, you know, what does it feel like for an investor actually with all the information, with all the requirements? Can we simplify that somehow? So I think there's a lot that we can do in that space.
So I take your point, but what we've seen recently is a series of financial shocks. You know, whether that is the tariff package, of course. We had some big moves in the bond market. We had Credit Suisse. We had Silicon Valley Bank. And what we've seen is that the European financial system has remained generally very resilient. We haven't seen any big problems. So maybe this is a question for the whole panel. I mean, we're talking about simplification. We're talking about growing Europe's capital markets. We're talking about maybe making life easier for non-bank financial institutions as well. Shouldn't the fact that the system has remained so resilient in this current moment, in a moment when we could really see, you know, things get pretty nasty, doesn't that mean that maybe, you know, we should be very careful with changing it as it is? Because, I mean, it has worked. And this is an argument that was made by the ECB's Claudia Buch. I mean, she didn't put it quite the way I did recently. And I have to say, I found it quite compelling, you know, be careful with your simplification. So I'll open that to the panel. Maybe we can start with you, Fernando, because you're an ex-central banker, so maybe you have a view on this.
Okay, I think not all central banks are cut alike. There are some nuances here and there. No, but I tend to be very financial stability oriented. I'm saying take that for granted. But I think in certain areas, so in general, the idea of deregulating at large, I think it's not very, because of some evidence. It's anecdotal evidence, because you may also put it in the argument in the other way around. If in large stress you see no signs of financial stress, maybe you've overdone the thing. So I mean, that argument goes both ways. So I wouldn't take it in either direction. But I think in certain areas, at least, first, simplification is a must. I mean, is the argument of efficiency. Can you get the same outcome with less resources, less waste? I mean, that's a no-brainer. So that nobody should be against that. If you move one notch further in terms of deregulation, you can have the argument across the board, which I don't tend to share. But in specific areas, I think it's quite obvious we have to do it. And one of them has popped up before, which is securitization. We clearly know we overdone it, okay? Because the diagnostic was wrong from the beginning. There was, I mean, exactly the loss rates we had in that product in Europe were exactly as expected by the ratings. So, I mean, there was no problem in there, and we just bolted all the bolts at the maximum, and we killed the market. We know we overdid it years ago. So now it's time to undo some of that work. And the problem is we don't know exactly which bolt we have to keep a bit looser, because there are so many. That's an area where I'd suggest to be as bold as you can, because you know that even if you go to the previous, if you undo everything, the system was as safe as it was supposed to be. I mean, it's simply we overreacted to problems in other jurisdictions. We're preemptive to a large extent. Of course, I'm not claiming we have to go to abolish everything, but we can be very bold and still be on the safe side. I want to be on the safe side. I'm financial stability oriented, but securitization was not, in that case, was not part of the problem. It performed in Europe as expected.
In the GFC, you mean?
Exactly as expected. No more, no less. And it was a big shock. It was a global shock. So here we are on the safe side. There are areas where you can experiment and areas where you cannot experiment. In this area, you are on the safe side. It's a control area, and you know you can experiment and be bold and still be on the safe side. So try to be bold in those areas. Areas which are in the unknown, please try to be conservative. But in this area, you can be very bold, and that's the beauty of. And I hope the Commission will get because. As I started, maybe there will not be a fourth time to get it fixed.
So I'm going to take the securitization theme, and I'm going to use it to ask a question from Slido, from Emily Breitsbird, who asks, where are we on the idea of an EU securitization platform? How could it look like? Which EU guarantees / backstops? Who is working on it? In parentheses, at speed. I don't know if that's wishful thinking or not, but Alexander, maybe that one's for you, I think.
It's a good question, and I mean, also to disclose a bit of secrets here.
Please.
I don't think I don't think it will be part of the proposal that will come, for the simple reason that we don't think we need a legal basis for that. I think that is something one can set up. I think member states can also do this together. We think it's an interesting idea, but we also know that there are a bit of different views around the table in the member states. But I would see this as something where we can also pull the industry together. We can facilitate it. We can use our, let's say, role as Commission to collect views. So let's continue a dialogue on that.
Are you working on a non-legislative proposal on this?
I don't even think we need any proposal on that.
You don't even, you can leave it to the member states.
But again, I mean, this is purely a legal issue. But I think we remain interested in this topic, but we need possibly also, I mean, in the end, not for us to set it up, but if there is the will and member states want to do it, the industry wants to do it, maybe also the EIB or others want to get involved, who have quite good experience, fine.
Well, maybe Bertrand, I don't, maybe this is a bit niche, but is there interest from the part of France to set up such a platform together with other member states?
No, well, it's a good example where I do agree with Alexandra. It's not about creating a platform through a regulation. It's not really a legal issue. It's more a practical and financial questions. So it should be, I would say, driven by the private sector together under the aegis of the public sector. It was one of the key recommendations of the Noyer report, to reignite the securitization market in Europe. And as Fernando just said, this market is in a very poor condition, if I may say, today. So we are waiting for the Commission proposal on this, but this might be part of a broader agenda to relaunch this market. Typically, something on which we could work in the context of the lab, where you could imagine that a couple of member states decided to propose together, possibly with EU institution. You referred to the IB, but might consider other candidate. Such an innovation. The last point I would mention is that you need to look precisely at this topic because you don't find this kind of platform only in the US. You need to look at what is done in Canada, in Japan, and you can see there is quite a number of options with more or less public involvement in the system, but clearly also benefits for the efficiency of the securitization market in terms of securitization, efficiency, legal procedures that needs to be properly assessed before taking any decision. So it's really a question under review.
Okay. Great. I see we're running low on time, but Verena, I did want to hit on the topic that was mentioned in Joanna's session of single supervision. I wanted to know how you're looking at this. How ready are you to move into that role? Should you get to that point? And yeah, general preparedness.
I mean, first of all, I think obviously it's important to emphasize that ESMA is actually already a direct supervisor at EU level. We have responsibility for certain parts of the financial sector. It's quite specific, only narrow sectors, but where ESMA is the day-to-day supervisor at EU level, and it's only ESMA, the national competent authorities don't have any responsibilities. And that is also expanding. We've been given new mandates by the co-legislators, for example, into ESG ratings recently, consolidated tape providers, and so on. So first of all, I would like to say, we have the experience. We have actually got supervisory experience, and we have shown that you can do that at EU level. And actually, we were supervisors at EU level 3 years before the SSM was created. So in a way, we're the oldest example of that. Having said that, I think we obviously believe that we would also be ready to pick up additional responsibilities and mandates if the Commission and the co-legislators decide to go in that direction. At the same time, I believe it's very important to emphasize that the vast majority of the EU financial markets will remain supervised at national level, and rightly so, because that's where the expertise about the local market players, the local investors is strongest, and that makes sense. What we are talking about, and where ESMA, the board of ESMA with the 27 national supervisors actually made some proposals, is to consider for significant cross-border market infrastructure groups, for example, to think about whether you should lift that supervision to the EU level, because there you have genuine cross-European risks. You have actually the problem of unlevel playing fields if that's not done in a very clear and a common way. And you also can create some efficiency for the companies involved who are currently needing to go with a new product to 5, 6, 7 different regulators to get the approvals. And so I think there are various rationales, but you need to look at each area critically. Where does it make sense and where does it not? And I think that debate has to happen.
No, if
Please,
I may,
Fernando, yeah.
We have scarcity of time and scarce of political capital to make this happen this time. The two things that I think are, or three things are more crucial, is going back to securitization. The idea of the platform that has a lot of potential, and as Bertrand mentioned, many countries have it. And in Europe, we've decided because we've been unable. And we've tried to skip the conversation. I think it's a shame that we have momentum, not really just say, okay, legislation is not needed. Let's not put political capital on this. That has transformative potential. The other one is centralization, some sort of centralization of supervision in certain key areas where it makes sense. Because even if it's not the best supervision in the world, you may think the system in one particular jurisdiction is better, but doesn't matter. One fair single supervision eases the life of the supervised much more than having to deal with excellent but different 7 supervisions. So that has transformative potential. Let's concentrate on what has transformative potential and use it wisely. Sometimes, and I fully share, having too wide objectives at the same time and too many doesn't do the trick. So let's work together to make it happen this time.
Great. Well, we've run out of time. So on that note of focusing on a few key objectives, which seems to be the general agreement on the panel, we can wrap it up. And I'd like to thank all of you for the very interesting and productive discussion. But before we go, I wanted to take a quick look at the poll presented by MFA. And just as a reminder, the question was, what is the biggest obstacle to turning the EU's savings and investments union into a true engine for competitiveness? Oh, there we go. And it is political fragmentation, blocking capital markets union progress. So it is the political obstacles remain, although, from what we've been saying, it does seem like there's also momentum on the political side. I'd like to thank again everyone who joined. To those on site, you're welcome to stay for coffee and sweets upstairs. And I'd like to thank the MFA for making this event possible today. And we'll see you again soon on June 10th, in fact, because we have our next event on scaling up clean energy in Europe with EU Commissioner for Energy and Housing, Dan Jorgensen. And then on October 1st and 2nd, we have our flagship Competitive Europe Summit. So thanks so much, everyone, for joining.
Thank you.
Yeah, it was great. It was.
Talked for a lot longer on some of the issues. I wanted to come back.